Hello traders, welcome back to the Forex Gig where we dive deep into the tool that can help you make smarter trading decisions. And in today's video, we are going to be talking about the lesser known yet powerful candlestick pattern that can significantly enhance your trading strategy, the side-by-side candlestick pattern. This formation is often overlooked but can provide valuable insights into the market trends, helping you identify potential continuations in both bullish and bearish markets. By understanding how to recognize and use this pattern effectively, you can refine your trading approach and potentially increase your profitability. So stick around with us until the end of this video to help to learn how to identify and leverage the side-by-side candlestick pattern for a better trading outcome. We start by understanding what the side-by-side candlestick pattern is. The side-by-side candlestick pattern is a three-candle formation that signals a continuation of the current market trend. It appears in both the bullish and bearish trend, providing valuable insights for traders. How do we spot the bullish side-by-side? The pattern forms in an uptrend and consists of three white candles, which are the three green candles we can see here. The first candle is followed by two more green candles with similar opening position. It creates a gap above the first candle. So after the first candle, you will see a gap before you see two side by side bullish candles. This formation indicates that buyers are confident and the uptrend is likely to continue, while the downtrend or the bearish side by side candlestick pattern is a similar version but forms in a downtrend. It starts with a large bearish candle followed by two green candles opening around the same level or below, two or more candles, and these candles close below the first candle, and there should be a gap downward. After the first candle, there will be a gap downward before you see the two bullish side by side candles. So despite the appearance of these two green candles, the pattern suggests that the bearish trend will persist. So this is basically the pattern and what it is about. This is how the patterns looks like. So let's go to the real live chart and see how we can incorporate this trading strategy, mastering the side by side pattern, to our real life chart. So to effectively use the side by side candlestick pattern in your trading strategy, you follow the few steps. First of all, you identify the trend, and as we can see in this area, price is currently in an overextended bullish move. We are anticipating a bearish reversal. This is an extended bullish move, anticipating maybe a retracement to continue the bullish move, but it is presently to the downside. For a bullish continuation, you can spot the trend will be in a upward direction. But to identify the trend, you can also use trading indicators. You can use trend indicators such as your moving average. You can use your moving average to identify the general trend of the market. This step is crucial because the side by side pattern indicates a continuation of the existing trend. So seeing this in this area below the SMA, below the simple moving average, indicates selling pressure, while seeing the bullish signal above the SMA indicates bullish signal. So when we see something like this, using the moving average, we can deduce the direction of the market. Secondly, we have to spot the pattern. Once you have identified the trend, you look for the side by side candlestick pattern, and as we can see, this is a bearish candle followed by two bullish candles staying side by side. This is exactly the pattern we are looking for in a bearish confirmation. For a bearish confirmation, while for the bullish confirmation, we see the first candle, then we see a gap in price. Remember, the bearish had a gap in price before we saw the bullish candles side by side. The bullish candle, the bullish formation, the bullish continuation, we saw three green candles. where the first one gapped. After the first candle, it gapped in price to form two green candles side by side. So that means the gap is important in price. After the gap, you look for the side by side candle. The third step is to confirm the volume. To confirm the volume, we will add our volume indicator to the chart to confirm the volume at that area. We check the volume to increase during the formation of this pattern. So when price was forming this pattern, we will look for an increased volume, and at this area we can see the volume was not lagging, but it was in an increased form. As we can see from this area, on the chart, we can see that the volume was being increased at this area. Now looking at the bearish scenario, we would look for an increase in the volume of this area, and as we can see in this area, volume increased. There was an increasing volume. There was no dip in the volume in this area. So confirming this with your volume is important as well. The higher volume adds credibility to the potential trend continuation. So we can also, the first step is using additional indicators. By combining this pattern with indicators such as the MACD or the RSI can be helpful to this strategy. So quickly adding my MACD, which is my average, my moving average convergence and divergence, to this trading setup. This step helps us to ensure that we are entering a trade based solely on the low reliability of the pattern, but on the strength of the trend. We are not entering this solely based on this pattern, but on the strength of the trend. And as we can see from the MACD, when this pattern formed at this area, we saw a crossover to the downside. We can see the MACD had a crossover, a bearish crossover, further signifying that it is in a bearish trend. We can also see the histogram. The histogram was bringing out, was showing us bearish concentration or bearish volatility in the market. When we go to the buy scenario, we can see we first of all saw a bullish crossover, signifying that the market is trending to the upside, and we can see that the histogram was beginning to increase, showing us a bullish sentiment in the market. So using this indicator can further increase our reliability on this pattern. So for a bullish pattern, how do we enter? We enter a long position close to the third candle. So once we have confirmed the third candle, we enter a third position close to the third candle. This is where we enter the long position, and we enter above the high of this pattern for a bearish trade. For a bearish trade, we enter above the high. Remember that we need to see a gap in price, and we see two bullish candles. So at the close of the second candle, we enter at that high of the close. We set our stop loss, because stop loss are very important in any trading strategy. We set it at above the pattern for a bearish trade, above the pattern. So you are setting it above the entire pattern in a bearish trade. For a bullish trade, you set it below the pattern. You set it below the first candle, the whole start of the pattern. This is where you set your stop loss. This helps us to manage our risks and protect our capital. The seventh step we need to know is managing our risks. We have to limit our position size to a percentage of your trading capital that aligns with your risk management strategy. This ensures that even if the trade doesn't go as planned, you can absorb the losses without a significant impact on your overall trading performance, which means an overall trading account. You do not have a significant impact when you take a loss on your trading account, because you are managing your position size and your risks effectively. Always monitor the reversal signals. Always keep an eye when you spot these signals. You keep your eye on your market direction, your market price action, to know when you can spot this strong reversal candlestick pattern or change in market conditions. This might signal a trend reversal. So even if you are in a trade and you spot a change in market condition, it's a signal for you to exit your trade. You can also set your stop loss to a risk to reward of 1:2, or you can use a trailing stop by considering any reversal pattern. you see along the way when trading this opportunity, this trading strategy, when price is getting to an area that you are beginning to see signs of reversal, you close your trade and you secure your profit by adjusting or closing your position if necessary. So when taking this trade, you have to keep an eye on the market to monitor reversals signals for both the bullish and the bearish scenario. Alright traders, we have come to the end of this video. If you engage with us in the comments below, we want to hear about your experiences. If you found this video helpful, do not forget to like, subscribe and turn on the notification bell so that you wouldn't miss out on more trading tips and strategies. Thank you for watching and I will see you in the next video.